Ladies and gentlemen, we're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here with the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session, the second in a series on position adjustments, we'll focus on the covered call and take a look at how your approach can change when the market shifts, and we'll go through it all in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of the retail market to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note there's a box on the right side of your screen where you can submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, Rolling with the Market, Position Adjustments, Part 2. Joe?
Hey, Nick, thanks so much, and thanks to everybody for joining us here on a hot summer day. Actually, pretty fired up about getting into Part 2 of managing, option positions. I think, we're obviously going to cover the covered call type positions today, but the practical application of this and the other parts of our series here, I hope apply quite well for all you listeners out there. As we get started with each of these, I think most of you are in the option space already. We've got the ODD, the options disclaimer document, and it's all about the characteristics and risks of standardized options. So be sure to check that out either through the OCC or through your broker. For those of you, and one of the great things that Nick and I, we get a lot of responses from all of you to the surveys and then the various questions, and a solid probably 40 to 45% of you are first-time OIC attendees. That's why we throw this and the next slide in with each of the different presentations, just so folks know who the OIC is. We are, an educational entity sponsored, a cooperative sponsored by the listed U.S. options industry. It's the OCC, the clearing entity, along with the 12 option exchanges that fund us and have since 1992 to be able to bring, different types of education to you. Here is, the growth of our industry from inception back in '73 to current. We're on a pace this year that mirrors last year's pace of just over 4 billion contracts for the year. That averages to somewhere between 16 and 17 million contracts per day traded over the 12 exchanges. So today, similar to Part 1, we're going to go through a little bit of review. We're going to talk about the covered call. We'll define that, obviously. And then we're going to go through different scenarios. You've got this real-life position. How do we adjust? What's the motivation for some of those adjustments? That's what we're going to go through today. So covered calls. Many of you, I'm sure, are at least familiar with covered calls, whether you've used them or not quite sure. But, covered calls are one of the most popular one of the most popular option strategies out there for sure, especially in this low interest rate environment. For those of you who aren't familiar, a covered call is when you sell a call and then buy 100 shares of the underlying. And you can do that in a couple different ways. You can do it simultaneously. When you do it that way, the terminology is a covered rate or a buy rate. You may own a lot of different stocks in your portfolio, and from time to time, you just decide to sell a call against each 100 shares of the underlying, unless we're talking about mini options, where those options correspond to 10 shares of the underlying, but that's only with 5 underlying. So the vast majority of covered calls are 100 shares corresponding to each call that you sell. And with covered calls, what's really important is, you start with a forecast on the underlying, and we'll get into, obviously, the risks associated with this type of position. But a covered call, ideally, is, your underlying forecast is and when I say underlying, I'm talking about the index, ETF, or individual stock. So your forecast for that entity is generally neutral, to bullish, not wildly bullish typically, but neutral to bullish. Sometimes you're looking for a small price range, but generally, you're looking for a rather controlled movement with the position. Now, the primary goal, and this is why so many folks are using covered calls, or at least considering covered calls, that primary goal is to increase returns. We know, it's such a low interest rate environment. It's a real challenge to get returns, and the idea of the covered call is to increase returns. Basically, it's all about the call premium received, which you will keep or roll into another call premium, and it's that income on top of any appreciation or potential dividends that allows us to have increased returns. Like any call writer, and call writer, we're talking about a call seller. You don't take in premiums without having to give something back, and what that is an obligation. So call writers or investors with short call positions have an obligation to sell the underlying shares, index or ETF, at the all-important strike price. And, of course, that's if assigned. We've always got that obligation, but we don't always necessarily get assigned, and we'll go through exactly what that means as we move forward. The long stock, in essence, gets collateralized by the short call obligation. So we've got the long stock. Depending on where the stock settles at expiration, we may be obligated to deliver the short shares of stock. And as I said earlier, each call corresponds to 100 shares of the underlying. So that ratio is really critically important. I mentioned the strike price. That's really your target price for selling the stock, which gets back to this whole idea of having a forecast for the underlying. So these are some of the nuances that are involved when we talk about covered call positions. Assignment is when your obligation has to be delivered, and essentially assignment with options. We've got rights when you're long options and obligations when you're short options. So assignment is the short option obligation, and when we sell a call, the potential obligation is to have to sell the shares of stock at that strike price. And that can happen any time up until expiration, because most of the listed options that we offer are American style, which means that they can be exercised at any time. And then in terms of when to expect it, if the call's in the money at expiration, certainly you can expect to be assigned, and then we'll go through some other possible situations as well. The dividend is one of them, and basically we can expect to be assigned with an upcoming dividend if the option premium in that short call is smaller than the dividend to be paid. So that's moving on a little bit, and in general understanding, it's real important. Nobody likes surprises with their investments, and so controlling this whole idea of assignment. In the money calls with no premium left generally, will be assigned sometimes before expiration, and then with the dividend, as mentioned, if the call premium is less than the amount of dividend, if the size of the dividend is greater than the premium of the short call, there's an awful good chance that you will be assigned. Let's talk a little bit about profit potential. Okay, when we talk covered calls, and really no matter what option strategy, it's always a good idea to know whether you've got unlimited profit potential to the upside or limited profit potential to the upside, and conversely with your risk. Do you have limited risk or unlimited risk? And when it comes to profit potential with a covered call, it is certainly a limited upside profit potential. And the way we define the two areas of potential profit are the potential appreciation of the stock to the strike price, and then also the premium received from the short call. So those two potential profits combined is the maximum profit potential that we can realize either right at expiration or possibly before if we happen to get assigned beforehand. In terms of the break-even point, and again, whether it's covered calls or some other option strategy out there, it's always a great thing to know in your mind, rock solid, what's my break-even point? And when it comes to covered calls, it's very straightforward. Actually, most option strategies, your break-even point, it's pretty straightforward. Some of the multi-leg strategies may get a little more complex, but when it comes to covered calls, the break-even point is very simply the stock price paid minus the call premium received. And, it really doesn't get much simpler than that. So that's the profit side. On the risk side, on the potential loss side, let's talk about that a little bit. As the slide says, maximum loss potential is substantial. And that's because our break-even point, as we just discussed, is the stock price minus the premium taken in with the short call position, giving us the covered call. So if we sell a call for 50 cents, we get 50 cents of downside protection. We sell a call for $3, we've got $3, and so on. But the bottom line is, after that premium has been taken out of the picture, after a stock has declined below that amount of premium, we've got substantial risk, and the risk in the position is that long stock. And that gets back to what's this presentation about? It's about covered calls and managing covered call positions, and we'll go through a number of different scenarios to managing the covered call position. But importantly, your maximum upside profit potential is limited with the covered call, and your maximum loss to the downside is significant because, after all, it is the long stock less the premium taken in where the risk comes in. One other comment on the slide talks about, remember, upside loss potential for uncovered calls is unlimited. This whole idea of naked calls, naked puts, if we're short calls without the underlying stock, we do have unlimited upside loss potential, and that's something to keep in mind. The call premium's limited downside benefit, really we just talked about. Your BEP, or break-even point, is the stock price less the premium we take in. And that gets us back to this whole idea of what strike. And to me, in options, and those of you who have joined before, you've heard me say, what strike, what month? You know, they're the challenging, yet at the same time fun questions when it comes to investing with listed options. What strike, what month? How much risk to the downside? How much profit potential to the upside? How do I maximize that ratio? In terms of covered calls, getting back to that whole idea of what's your forecast on the underlying, you have lots of different choices with which calls. Take into account when dividends are paid. Take into account when earnings come out. And then we've got this whole idea of, do we want in-the-money calls, at-the-money calls, or out-of-the-money calls when it comes to covered call writing? And each of them will have different risk profiles and different reward profiles as well. So if we talk about in-the-money calls, and those of you new to options, that means there has to be some intrinsic value. And in-the-money call, let's say the stock's $50, a 45 call would be $5 in the money. A 45 call would be the right or obligation to buy or sell stock at 45. And with the stock at 50 in the marketplace, that call would be $5 in the money. An at-the-money call would be, so let me back up just a second. So we would have, the value of that option would have to be at least $5 plus whatever time premium. So we would have, some fairly significant downside protection when it comes to a covered call $5 in the money. When you're talking about writing in the money calls, it tends to be a little more defensive, certainly more defensive and more conservative. That's the approach. But this gets back to what's your opinion of the underlying. Writing at the money or out of the money calls, there is no intrinsic value. Back to our $50 stock example, a $50 call would be an at the money call, and if we went to maybe the next strike up to 55 calls, they'd be $5 out of the money. Well, depending on how much the stock moves around, that $50 call is going to have depending on how far out in time we go, a decent amount of premium. But as you get to the out of the monies, you're going to have far less premium and then also less downside protection, because the premium we'll take in would certainly be less the further we go out of the money. But then, getting back to, if your forecast tends to be pretty bullish on the stock, maybe you want to sell an out of the money call. And we'll go through some examples. So the whole decision, do I sell an in the money, an at the money, or an out of the money, is critical when it comes to maximizing your profit potential with covered calls. So let's talk about managing, and just the whole idea of managing for a couple slides before we get into the examples. So management tools, whether it's covered calls or any investment for that matter. One absolute management tool is, you had an opinion, you were wrong, it's going against you, get out. Taking that loss can oftentimes be the best trade. It not only can save you capital, but it can also free up the mind to allow you to move on to another investment as well. So when we talk about management tools, getting out can be a consideration. Do you or are you willing to accept assignment? Whether it's because the stock has run up and there's no premium left in the calls, or because of this whole idea of early exercise due to a dividend. And as we initiate covered call positions, again, things to focus on: is there a dividend? When is it? Of course, there are earnings. When are the earnings? Things to keep in mind. Choices we have as we manage our investments through options: rolling up, rolling down, and rolling further out in time. These are all choices. Actually, we'll go through an example of each as we go through. Avoid selling stock and leaving a naked short call we talked about earlier. Be very, very careful about those naked short option positions just because of the significant risk and margin requirements that often come along with positions like that. So when do we consider making adjustments? Really, there are a couple, broad categories. Maybe we're lucky enough to have been dead on. Our forecast was right, and we're ready to take or, enhance profits. That's one time maybe we consider adjustments. Cutting our losses, critically important. Adjusting time frames. And then as we do all of that, certainly we're modifying our break-even points and those P&L profiles. And in terms of when adjustments might be made, starting with a plan is critically important, and whether it's options volatility and the amount of premium that guides us into different option positions, whether it's the forecast on the underlying, and hopefully those positions that you're taking on are on underlyings that you're very comfortable with, and then you've got the plan. If XYZ stock goes up to a point, I'm rolling. If it goes down to a point, I'm rolling down, or maybe just getting out. And then always this idea of, avoiding assignment if that's the approach that's most important for you. A lot of folks and investors have stock that they've had in their portfolios for a long, long time. They don't want to lose that stock through assignment. So managing short call positions prior to assignment can often be the most important thing for some investors. So rolling a covered call up, when we talk about that, it's really very, very straightforward. We buy a short call with one strike and write another one with a higher strike. So the terminology is just rolling up. It's always a net debit because in essence we're doing a vertical call spread, but closing down one side and buying the next. We do raise the break-even point by the debit amount, and certainly we increase the maximum profit potential, but we do raise our break-even point as well. So there's a trade-off. And again, that's where having an opinion on the underlying is very important. If we take an $80 strike as an example, we've got good old favorite stock XYZ. Maybe we were short the June 80 calls. We buy back the 80s to close, and we initiate the sell of the 85s. And it really is that simple. For folks who are in the option space, it is straightforward. For those of you who are new, it's a question of getting comfortable, having a plan, and then massaging and executing that plan. Rolling down is exactly the opposite. We buy the short call in the one strike, and then we write another call with a lower strike. So in essence, we're doing a vertical credit spread, always a net credit. And when we do this, we lower the break-even point by whatever that credit amount is. And we, of course, by doing that and rolling down, we're decreasing our maximum profit potential. And back to that $80 stock, if we were short the 80 call, we would buy back the 80 call, and to roll down, we would then sell the 75 call. So selling that 75-80 call spread in essence. So when we talk about rolling, we're certainly talking about two transactions. You can do them individually or as a spread. I much prefer to do it as a spread because depending on whether your forecast has changed to the upside or downside, and if we're talking to the downside, chances are the forecast your forecast, at least in the short term, has gone the wrong way. So I don't want to horse around with doing one leg and then trying to just get a little bit more out of the market. I like to keep it clean. You know, when I go into these types of positions, I've got my roll to the upside number and my roll to the downside number, and if those numbers are hit, I roll. And, you know, I roll based on the price of the vertical spreads. And, you know, the other consideration is, do I roll out as well? And that just depends on the, you know, individual circumstance. But, you know, you've got two choices. You can do the spread order, which is, you know, what I prefer, but then you've got the whole idea of legging into the roll too, where, you know, you may buy the one side and then sell the other one a little bit later, or vice versa. Again, you have to be careful about which side you're doing first, because you really ideally don't want to get into a situation where you're short a call and then you sell another one waiting to buy back the other, and you get into a situation where you're just short more calls than underlying stock. But, you know, that's position management, and in the end, that's your own individual choice. You know, this really is my approach, having that predetermined stop loss point, and that goes back to, as we've said a number of times, the forecast on the underlying. How do I get my forecast on the underlying? Well, there are companies that I'm familiar with, certainly from a charting perspective, and then for me personally, it's less of a fundamental issue. You know, I do follow fundamentals of companies, but for me, I much prefer the charts, and so I pick points off of the charts where I'm rolling down or rolling up. So let's get into a couple specific examples. I think we get 4 or 5 of these, but let's start with our initial position. So we've got good old XYZ, and XYZ is currently trading at 59. You can see our forecast is neutral to bullish. So we're going to buy 100 shares of XYZ at 59, and we think over the next 90 days or so, which will take us out to a March expiration, we're looking for the stock to be somewhere maybe just above $60. So really that just out of the money strike, that 60 strike with the stock at 59 would be out of the money by just a point for you folks who are just getting started with options here. So we buy 100 shares of XYZ at 59 and sell a March 60 call that has about 3 months in time, about 90 days, and we sell that at $4. And this is what it looks like. The dotted red line represents the stock. So we are long at 59, make money to the upside, lose money to the downside. That's pretty straightforward. That blue line represents the position we just spoke about. So we are, long stock at 59 and short the March 60 call at $4. So you can see where we've got, as we said earlier, and I always look at positions from the risk side first. All right, what's my worst case scenario? Profits, we hope our forecasts are going to be right over time, and we're going to make profits. But I don't like surprises, so what's my downside? And we can see, as we suggested earlier, the downside is significant in covered call positions, because after the protection from the credit taken in from the short call, we've got a long call position. So that's why that blue line continues to head, down to the bottom left, because, below 55, we're just straight out long stock. But again, our forecast was neutral to slightly bullish over the next 90 days. Well, why does that blue line go straight across as it does versus the dotted line that goes straight up? That's because we've sold a call, and we've basically sold an obligation to sell stock at $60 plus that $4 of premium. So you can see our maximum profit there, that $500 on the left suggests our maximum profit, which we will get into. But the break-even point, so know that break-even point, it's the price of the stock minus the credit we take in for the sale of those calls. So it's 59 minus the $4 takes us to $55, and that's our all-important break-even. So here's a chart that describes that snapshot that we just saw. And I hope, we started at 55. You can see that's highlighted a little bit. And the far right-hand column is your total profit or loss. Well, at 55, we are breaking even. We bought the stock at 59. We sold the call for 4. So 59 minus the 4 takes us to that break-even point at 55. That's excluding commissions. So our break-even point would actually be a little bit higher. But take a look at again, on that far right-hand column, the top box and the bottom box. Okay, we can see we've got a maximum profit of $500 with the stock at 65. And then on the downside, that bottom right box, we've got at a maximum loss of $1,500. And you can go over to the left there with the stock price at 40. So see how really this position works. To the upside, above $60, our stock, our return from this position maxes out at $500, no matter how high the stock goes. To the downside, because once we go below that break-even point at 55, we lose point for point with the stock. So that's why, at $50, we're down $500, at 45, $1,000, at 40, $1,500, and so on. But so understanding that far right-hand column is important, and I think it actually helps you also in defining when you want to roll. To me, it's a combination of the underlying chart and where my threshold is for pain. So that's a look at the initial position. So another scenario, we remain moderately bullish, and we've got 6 weeks to expiration, and we decide to do nothing. What's changed is we've got the XYZ is currently at the break-even point. That's what's changed. So we were neutral to moderately bullish in the original scenario, but over, let me see, we had 90 days, so over 4 or 5 weeks, the stock has headed south 4 points, maybe more so than we thought. But we remain moderately bullish, so we decide we're not going to do anything. Those March 60 calls are currently at $1 with 6 weeks remaining. We sold them for $4 originally. So we've got an unrealized loss of $1. Stock's down $4, options are down 3, and we're down $1 potentially. The investor, because the opinion is still hang with this position, we do nothing. And yes, can it be a risky tactic? Yes, but no risk, no reward, basically. And just this gets back to the idea really of being comfortable with the underlying, having an opinion based on fundamentals or charts, and then making decisions accordingly. Another potential scenario, XYZ unfortunately has plummeted, and we are completely wrong in our forecast. Well, if we're wrong in a forecast, chances are we should lose money. I mean, I know that's how it works for me. Maybe some of you are more fortunate, but that's definitely how it works for me. In this particular scenario, we decide we're out. So we've gone from being neutral to moderately bullish on this underlying to very bearish. So if we're very bearish, it makes all the sense in the world. Get out of the position. Covered calls are positions with significant downside risk. Whether you go from neutral to moderately bullish to very bearish means you want to turn around and put on a bearish position, that's again up to you. But when it comes to our covered call here, the decision is to get out, and in order to get out, we have to sell those 100 shares, or depending on how many times we've got the position on, sell XYZ shares, and then buy back those March 60 calls. And it's not about just selling the stock; it is about doing both sides and getting out of the position, closing it down, and moving on. If those March 60s still have some premium in them, and you sell the stock and stay short the March 60s, well, you've got potential significant, unlimited, actually, risk to the upside, but you've also got a whole different situation from a margin standpoint as well. So, it's not about just doing one side of the position. It's about getting out. Rolling down, the investor is now somewhat defensive. So we've got about 6 weeks, again, to expiration. Originally, the position started with 90 days, so we've got 6 weeks left. The stock, again, is at 55 and stabilizing at this level. So we decide to, and we know we're short this March 60 call at $1. We've got that unrealized loss. We're neutral on the underlying here at a lower level, but more defensive. So we think the best thing to do is to, rather than shut down the position, roll it down, and that will basically give us some upside profit potential, and that's really the decision. That's why. Well, let's go through the example. That's really why we consider rolling down as opposed to closing out for a loss. You change the dynamics, but you've still got profit potential in the trade, and that's the key. So we were short the March 60 for $1. We've got this defensive or less neutral opinion of the underlying at 55 now, which is where the stock is. So we decide to sell the 55 call, buy the 60 call. Again, we're doing this for a credit, which is $2. So we have lowered our break-even point by the $2 credit that we take in. Going back to the original example, long the stock at 59, short the 60 calls for 4, our break-even point was $55. If we take in the $2 additional credit, our break-even point goes from 55 to 53. So that's where this whole idea of being a little more defensive, but rolling the position to continue to try to make it a winner, not to fight it, but to try to make it a winner based on this new forecast for the underlying, will lower our break-even from 55 to 53. Now, if assigned, our maximum profit is going to be down. Originally, our maximum profit was $500. It was the stock appreciating from 59 to 60 and the $4 we took in for the sale of the calls. So the 100 plus the 400 got us to that 500 maximum profit point in the first part of the covered call trade. Now we would lower that to a couple $100 by making the adjustment here. So there's the March 60 call, and this is how it looks when we roll down. So we go from maximum profit potential of 500 to 200, but on the flip side, actually, we've actually lowered our break-even point now from 55 to 53. And, this just gets back to how do you feel about the underlying? How comfortable are you, in doing rolls? And starting out small is always a good approach for folks who are new. So rolling down, this is how it looks. Again, you've got that March 60 column as well as the roll down to the 55s. And, when it comes to analyzing covered calls positions this way, I always go to those right-hand boxes at the top and the bottom and see what's my maximum profit potential. You can see that maximum profit potential above 55 turns out to be $200, but it's a profit potential of $200, where if we had closed out, remember with the stock 55, we were talking about losing $100, because the value of the call was still $1. So we go from a potential loss to that potential profit of 200 if that's the approach you want to take. To the downside, we still have significant downside loss potential because below 53, essentially we're flat out long stock. So at expiration, short out of the money calls. What are the considerations here? XYZ has declined. It's expiration Friday. We've got the short March 60 far out of the money. Well, no action may be required. We can let that short call expire, and we retain the shares at that lower cost basis now from where we sold the March 60s before. But as we roll, if that's what we decide to do on Monday, we either want to be selling those shares to get out and move on to something else in terms of an underlying, or we're going to turn around and sell another call. So if we don't do either of those things, certainly we're going to be in a very different margin position. Another thing that we can possibly do is we could roll that. We don't have to wait until Monday. As long as we are short that March 60 call before expiration, we can just buy back the March 60 and sell either the following month or the month after that. But the important thing here is, again, not to be exposed with extra short calls. So we can roll that spread. Basically, the terminology would be selling the time spread. We would buy back the front month March 60 and sell the next month out, and that would, again, allow us to be short some premium around the underlying. Let's take a look at the flip side with the stock running to the upside. So again, our underlying opinion was neutral to moderately bullish. Things change. It's the great thing about the market. It's dynamic. And our particular underlying XYZ, things have changed, and now we're real bullish, but we still got 6 weeks to expiration. So the stock is going from 59 to 64. The March 60 calls have gone from 4 to 5 1/4. So we've got some unrealized profit there. But we're, as I said, real bullish. So what do we consider doing? Well, first of all, we should consider what's our new target price for the stock. That's critical. So many option positions and strategies get back to, what do I think about the underlying? And no different here. Target price has been raised from 60 to 65. We're very bullish, so we decide we're going to roll up. And we went through what that may be. That would be basically rolling into a bull spread. We're going to basically buy back that short March 60 call. In our example, we're buying that back for 5 1/4, and then we're selling the March 65 calls. The more important number is the debit we're paying. So we're paying $3 for this spread. So again, what happens here? We got a break-even point. That'll now be $3 higher because that's the debit we paid for this spread. So our break-even is going to go from 55 to 58. Now we're talking about a stock that's 64, so we still got quite a bit of room. And that's what happens if we've rolled up, buy back the March 60 and sell these March 65 calls. The maximum profit potential goes up as well. By $2 from 5 to 7. And let's take a look at that. So there's the March, the original position with our potential $500 profit potential. And then the March 65 calls, we got that new break even at $58 with an additional couple $100 of profit potential when we roll up in that particular call spread. So at 60, you can see, well, the break-even point is, as we've said, 58. To the downside, we've still got significant profit loss potential because below 58, we're just long stock. And then to the upside, our profit potential, can go anywhere from, 0 up to that maximum level of $700. And that's the effect of rolling up. So that's one different scenario. We didn't talk about rolling out. That's something you can do too, rolling up, rolling down, and then out in time. But we're just trying to keep it pretty straightforward, considering we've got the combination position, the covered call, where we're long the underlying and short the call. Before we wrap and go to questions, Nick, just a couple quick things to review in terms of early assignment. Okay, some people, when you've got a covered call position on, early assignment is, maximum profit potential. Your forecast is right, you've been called away, and away you go. But some folks want nothing to do with early assignment. And so, things to consider, how to avoid. If we're several weeks away, that option's going to have to be pretty deep in the money not to have any time value. So in our example, that stock would have had to have run pretty significantly, north of 60 to have still a few weeks left and not have any time value. That if it has time value, if that short option still has time value, you should not be assigned. Occasionally it happens because sometimes investors make mistakes and then they exercise different options that shouldn't be exercised from a time premium perspective. But typically the vast majority of the time you can manage it. If there's time value left, you shouldn't be assigned. We get into this whole idea of the dividend. If the dividend is larger than the premium of the option, close down your position if you don't want to be assigned, because chances are you will be assigned. And again, the different choices, rolling up and out, maybe one of the approaches you want to take. If the stock has risen an awful lot and you've got profit, basically where your call is down to no premium and you've got the position on still the covered call, take it off. Your profit is maximized. Sell the stock, buy the call, go to the bank and find another position. And that's really just, I guess, a combination of using common sense, but also at the same time understanding that your maximum profit has already been attained, even though we're not at expiration. And in that situation, all that you have potentially is downside risk. So, put the money in the bank and move on. So, Nick, I think from a presentation standpoint, of course, we always want to suggest to our listeners that our friends at Investor Services are always there at 888 Options, and of course they can find all kinds of different resources at optionseducation.org. So I hope we got a few questions.
Indeed we do, Joe, and I do want to echo what Joe's just said. Our Investor Services team is available at any time during business hours to take your call. Give them a call if we aren't able to get to your questions today. And also wanted to remind our listeners today that this session will be archived and it's going to be available for later viewing through the On24 platform. You will be receiving an email about the login information for that. So, Joe, got a number of questions. I think we got a pretty sophisticated group with us today. And I think the first question we have here is going to be one of your famous "it depends" scenarios. This investor mentioned that he doesn't usually consider a stock dropping in value on a covered call to be meaningful because he can just hang on to the stock and wait for it to rise again and then make premium on that later if possible. Would you consider that quote-unquote bad investing?
Well, who am I to say what's bad investing, Nick? I think that gets back to, a position that many investors find themselves in, either proactively or just kind of passively. I mean, so many investors are almost married to different stock positions, and that's, who knows why. Maybe the stock was given to them, or they've had it in their portfolio for years or decades, and they never want to give up that stock. So the approach that many investors who I speak to out on the road, Nick, is that, hey, I do the covered call on XYZ. I'm going to manage to stay away from assignment because I like this. And hey, if the stock plummets or heads south, it's gravy. The options that I sold are gravy. I wouldn't have sold the stock no matter what. Again, managing not to have to deliver the stock through assignment. So any option premium that I sell is gravy, and I think that's really just a mindset that a number of investors have. I wouldn't say it's bad investing, because it's really not for me to say what bad investing is per se. Is it the right type of position management? Well, it really gets back to, and you preface by saying my famous "it depends" answer. Investors have completely different motivations. I mean, in terms of how they plan to make profits. Of course, everybody's goal is to make profits, but how they get to that, just so many investors would never think of selling a number of their underlyings. So the call premiums they take in are just gravy, and if the stock plummets, they figure they're still ahead of the game because of those premiums they receive by selling the listed calls. So I think to a point, it's what depends, Nick, is the approach that the investor is going to take with those particular underlyings.
Another question I saw more than a few times was about collars. Would it be appropriate to use a collar strategy with any of the covered call strategies you discussed today?
Well, let's start by defining a collar. And it's a natural outgrowth of the covered call. Covered call, long underlying, short one call. And where the collar comes in is we add the long put. So collars typically are put on after a stock has run up quite a bit, and maybe somebody had an out-of-the-money call against their long stock. So not the at-the-money, but the out-of-the-money. So there's a pretty nice profit in that underlying, which has now gotten to the short call, and somebody can go in and buy the put in a lower strike price to lock in a point where they know they can be out of the stock, and hopefully for a profit. It is a natural outgrowth, but and actually on the on optionseducation.org, Nick, on our website, we do have both covered call and collar calculators that I would suggest our listeners check out. It's a very viable approach to roll the covered call into a collar, but typically you're not going to get a return unless you've already made some pretty good money in the covered call position.
Another question we saw more than a few times were about the effect of commissions. Could you talk a little bit about how the spread order could affect commissions?
Well, in each house has their own approach to commissions. So, in some houses it's a ticket plus, a nominal cost per option contract. Others, it's the individual contracts. So that's really a brokerage house to brokerage house situation that you got to know your broker and how they charge, and whether it can be more cost effective to get in there and do it via a spread as opposed to individually.
Joe, is there a good way to evaluate the timing of a potential early assignment when you're in the call, when your call is in the money by a good margin, and you're, say, a week out or 2 weeks out? Is there a rule of thumb that you can apply when you're looking at that?
Absolutely, and I love the question, Nick, because so many investors don't want assignment. If there's and let's talk for a second, and we'll jump ahead a little bit in terms of options terminology. Let's talk about call put parity. When we get into call-put parity, calls do not trade by themselves. Calls trade in conjunction with the price of the same put and the price of the underlying. And so if we're a week or two out and the call's, in the money by a fair amount, if the put has some value, that means that value is also going to be in the premium of the call, in addition to the intrinsic value. Okay, you throw in a dividend there, and that may complicate things a little bit. But generally, if the put has any value, if the put's got 25 cents of value, chances are that call is still going to have 25 cents plus or minus a little bit of time value because of this whole idea of call put premium. And that's why, it really is the vast majority of the time not that difficult to manage assignment. As I said earlier, sometimes people exercise options at the wrong time and you get assigned when you shouldn't. The fact of the matter is, if you get assigned early and there was still time premium left, you collected that time premium quicker. Now, the net effect may have been a taxable event with the underlying that you really wanted nothing to do with, but in terms of the position itself, you would have maximized your profit faster because by getting assigned early, all of that time premium disappears. So it's a good question, Nick. The two keys are if there's premium in the put, there should be a corresponding amount of premium in the call, and obviously you can tell whether there's time premium in addition to intrinsic value. And then the other bugaboo is, be very mindful of the dividend.
Joe, do you have any thoughts on covered calls using leaps instead of using equity?
Covered call, yeah. Actually, as a matter of fact, if we go back, I believe it was March 6th. Nick, you talked about earlier our on-demand opportunities for investors to go back and look at our previous webinars. Marty Kearney of the SIBO gave a full presentation on leaps as a stock substitute. So certainly you can use a deep in the money leap and then sell a front month call. Margins will be less because you're talking option to option, and the leap's not going to cost as much as the underlying. One thing, Nick, that our investors and our listeners should be keenly aware of when you start talking about leaps, okay, and this gets into how do options get priced. As we go further out in time, the whole idea of implied volatility becomes far more important. And as I think you're going to say in just a few minutes before we wrap up, our colleague Kyle Graham will be offering our next webinar on July 29th on implied and historic volatility. So the whole concept of using a leap as a stock substitute in a covered call position makes plenty of sense. I would just urge our listeners have an idea of what the implied volatility levels are in those leap options. And of course, how do you find that? Well, go to optionseducation.org, and under Tools and Resources, you'll find the volatility charts, and you'll get a very good sense for the implied volatility in your particular underlying.
Thanks so much, Joe. Ladies and gentlemen, we have come to the end of our session today. So, Joe, do you have any final parting words for our attendees today?
No, Nick, I just think this whole idea of rolling with the markets, we're really excited to be bringing this series forward. I know we're going to have one or two more going, sometime over the next month or two. So just thank our listeners for joining us.
Ladies and gentlemen, thank you again for your time this afternoon. We hope you learned something, and while we weren't able to get to all of your questions, as we mentioned, we have our Investor Services Desk ready to help. Give them a call at 888-OPTIONS, available during most business hours to answer your options questions. Joe referenced some of the tools that we have on the OIC website. The Position Simulator is available under the Tools and Resources drop-down of optionseducation.org. Feel free to look at that and figure out some of your own option scenarios. We'll be holding our next webinar on July 29th when we'll have Kyle Graham from our Investor Services team. He'll be talking about the topic of volatility, as Joe mentioned. Make sure to check optionseducation.org or keep an eye on your email in upcoming weeks for details on how to register. As I mentioned, these webinars are archived for later viewing on On24, so keep an eye on your email for login information for that. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.